Welcome back, everyone. This is Mike with Repliquants. It's Thursday, March 16th, 2023. Just a day past the Ides of March, so settle your debts, everyone. All right, strap on your helmets, everyone, because we're going in. Things are looking pretty ugly out there. And before we actually looking at the charts, I'm just going to do this thing really rough and dirty. Normally, I spend a lot of time stopping, pausing, looking at charts, recording, editing, and making it, as slick as possible for you guys. But I decided, oh God, this is so much work. And from moving forward, I'm just going to just throw things out there, and you guys either love it or hate it, okay? So I want to paint a picture here a little bit before we look at any charts. This is just statistics, and this is a statistics tool that I wrote many years ago because, well, for one, there was none out there that I could find that I really liked. And I was reaching out in the quant community, and well, nobody had anything resembling this. And so I wrote this thing, and I get all kinds of statistics, seasonal statistics. And what's important to understand here is that we're actually supposedly heading into the most bullish season of the year. And in the context of what's going on, this is quite sobering piece of information. But why? Because, this should be the profit center, right, for the year. You have the end of the year, right? The Santa rally. It's really more like an November rally. If you're looking at statistics, December's fairly flat in comparison with November and October, but the most netting months are usually March, April, and May, right? And then, go away in May. The old expression still holds true to a certain extent. July is actually quite strong, right? A lot of people don't know that, but, there is a lull in between. And this is usually kind of low liquidity, conscious, right? Rallies that happen. So there's really not too much going on usually in July. But yeah, we're getting some activity. But April, right? Where we're going to be in April, I don't know. We're already past the midst of March, and things are looking pretty ugly moving forward. So here's some news. I'm sure you guys are aware. SVB was just the first domino to fall. I mentioned that. I wrote an article about it the other day. Well, many others have too. And yeah, looking all across the the news universe here to see kind of what's going on. And I was reading this one here. It's kind of interesting what's going on. What I really liked the most about this article, I wanted to highlight this for you guys. This was my favorite part of this article. The tumble came, right? Big tumble obviously on Credit Suisse. It's in trouble. And they're going to be bailed out, I think, to the tune of 50 billion euros, right, if I remember correctly. And the tumble came after Saudi National Bank chairman Amarna al-Qudayri, sorry if I just murdered that name, Mr. Qudayri, told Bloomberg and Reuters that key Credit Suisse that the key Credit Suisse shareholder has ruled out further investment in the Swiss bank to avoid regulations that kick in with a stake above 10%. Okay. Sure, right, yeah, it's to avoid regulations. Mm-hmm. Well, it's a polite way of saying it. Just go, pound some sand, take a running jump, and also the 50 billion. If you're looking, what is the revenue? Annual revenue is about 15. The Swiss franc is pretty close to $1 at this point, right? Talking about $15 billion plus minus. And they're getting basically 3.6 times the annual revenue in bailout. I think they only have, let me see the statistics here. What is the market cap? 10 billion. Yeah. So, that sets a statement. And I think there will be other dominoes to fall. Most likely, right? And of course, for you guys, what you really care about, of course, what's going to happen moving forward? What is my risk exposure? And what should I be prepared for? And this is one thing I wanted to show you. Before we look at anything else, we're going to take a quick cruise through the entire market universe. But what we're looking here at is these spiders. Obviously, it's a daily chart, and it goes back a few years. I think 3 years here, right? What is that? Okay, I think it's here 2 years or 3 years. And what I've done, I've highlighted big volatility events, which are shown right down here. What I have is this kind of indicator I wrote, and this is called a Z-score. Right? Z-scoring is basically a way of putting anything you want to measure into context in terms of standard deviation. And don't run away. It's not that terrible. Like, it's just if you imagine the bell curve, right? One standard deviation is what usually people expect will happen, in a particular time frame or a particular sample set, right? And 68.2%. And standard deviations is very important. You measure things because you want to know how far outside the norm they are. It doesn't make any sense. And so what I did, and I write often myself these little, cute silly indicators, because they tell me things about the market that often are really not, they're not really visible. And what I've done here, when you just look at the chart, they're not visible for one. And I've actually done a z-score, not on price actually, but on volatility, on implied volatility. And then I also did some quirky math that allows me to have it in a range, right? So above 100 is usually quite extensive. And it's actually supposedly keeps it within, per the algo, within 0 and 100. I'm sorry, minus 100 and 100. So have it more normalized, right, in terms of visualizing it. So when you're seeing these huge spikes here, and then also put on that again a standard deviation line to kind of see, if I see thresholds where things kind of happen. And once I start doing that, well, lo and behold, what I see here is these spikes here. And what usually happens when you get this huge volatility spike, right? Because that's what it is, right? If you're looking at these spikes down here, that's implied volatility. What is implied volatility? Well, it is the expectation of volatility. And normally when people see volatility, they expect even more. So that's one of the reasons why volatility, implied volatility, is not normally distributed. People that's why you see maybe in a bull market, you see the VIX between, 8 if it's really, really low. We haven't seen that for a long time. And then it pops maybe to 15 or 18, but then it falls back, right? But in bear markets, right, you see the VIX go all the way to, it can go to 50, 60, 80. I think we've seen 80 readings. So it's not normally distributed. So you see these huge spikes, right? And that's what happens here. And I've basically, this indicator shows me this very nicely, and I kind of like it. Anyway, I'm weird like that. So what usually happens is you see these spikes here, and there's another one here, right? Right here, and every time there's a spike, there's a bounce. So I do this actually as a video today because, if I had to do this as a post, I would have been writing for like 3 hours, and the market actually opens soon because we haven't switched to summertime yet. Europe always switches 2 weeks later, which drives me bonkers, to be honest. Really, can't you guys get this, freaking synchronized? I almost dropped the F-bomb. Pardon me, guys. Party mouth. So here, this is one spike we're looking at, and you see there's this bounce here in it, but it doesn't mean necessarily, after that the bearish part is over. A lot of times we see a little bit follow-up. Nothing much happened here, but you'll see in future instances right here, for instance, right, we see similar thing. Pokes outside, there's the bounce, obligatory. It's like a dead cat bounce, right? You've probably heard this expression before. And then it falls back. And what we have here, okay, let's look again. Okay, we have to zoom in again. Same thing here. See, it bounces out, right, outside. This is actually 1.5. Is it? I think it's 2.0 on a 20, right? I mean, it's an indicator. And there's no magic indicator, just for the record, okay? You can just always kind of develop a mental model and visualize something, but there's no indicator on this planet that gives you like, okay, if this threshold is being hit, then this is going to happen for sure, 100%, right? You can derive some probabilities, but what I usually do, I also look at context. I look at context all across the board, because if you don't do that, it's easy to get fooled. Trust me, I've been through this many, many times in my trading career. And for a good example for that is, for instance, something like this. You see this spike here, and what happens? Wow. Right? It just completely wipes out. And this right here is actually the learning experience. This right here is the takeaway, guys. Because if you ever see a significant spike in volatility and you do not see a dead cat bounce, then really, really strap your helmets on, because things are about to get really, really wild. And that's what happened here, right? And this really kind of was the beginning of a medium-term bear market. And so let's keep looking here. Here's another one right here. So we have a similar situation where we're seeing this continued signal down here. See that? It keeps popping out. Admittedly, we had quite a bit of drop here, right? Quite a bit of well, what you call it, normalization, or a quieting down in implied volatility, and this kind of apparently caught the market by surprise, right? Looks like it. And there was some hemming and hawing, but then the whole thing fell apart. Admittedly, there's a little bit of a delayed reaction here. We're seeing several pops outside, and yes, then there is finally a bounce outside, right? But it falls right back out, and that's the stuff you always have to watch out for, right? Because this happens, and this happens quite a bit, and we see it happen over and over again. So we have a few more instances here, and forgive me for spending so much time on this one chart, but I think it's really crucial. Here we see the other extreme again that we talked about before. When did this happen? This happened in August, summer of 2022, last year. Fun times, right? Not really. Anyway, so here we're getting this big pop. We had one before. Oh yeah, we actually had one before. Okay, if you're real technical about it, we can move this line over here. And here was the first one. And there's a small dead cat bounce, and then it just turns around right away. What do we have here? Same thing. We have this. See, I drew this when I was zoomed out, so I didn't really get it perfectly. So here we have this little bounce, and it drops a little bit, and then it recovers actually, magically, and then it comes down again. So we keep seeing this over and over again. See here, same thing, right? Bounce, comes down again. Here, this is one instance where it's just kind of like, okay, this is it, we're done. Let's go for lunch, and then things continue, pop higher. This one I don't count because it's not touching, but okay, you could kind of count it as well. And that brings me to today. So this is what we want to talk about today. And again, technically speaking, let me select this thing. Nope, I don't want this. Thank you very much. Just want to select it and move it. Okay, come on. It doesn't understand my accent, I guess, right? Here we go. There you go. Okay, this is kind of weird, right? Because here we already bounced, and it draws this line. So we have one here, right here. We are outside, right? And it's actually a little bit kind of like it already drew down after pushing outside. See that? So I'm kind of unsure about this, but there is huge risk here that we actually just kind of drop here and drop into oblivion. And well, that brings me to a bunch of other charts that we want to probably look at. So let's look at the banking sector, of course, right? Let's look at Credit Suisse, right? And what I have here is I've got a similar indicator on here, which is actually expected move. It's also related to implied volatility. It's actually closely related to implied volatility because it's basically what options are priced against, right? So we're talking about one standard deviation. Let me actually pause real quick and get my drawing tool, and maybe I can draw this for you guys, okay? Okay, so I hope I have my drawing tool working here. So I'm gonna try to draw it with my mouse. So forgive me if it's looking like crap. All right, so imagine we have this beautiful, well, not so bad with a mouse, huh? Okay, it's almost recognizable. So we have this bell curve. We're talking about distribution, and I talk about implied volatility a lot because I'm weird like that. Because I think these days especially, right, and especially since 2013 with the proliferation, pardon me, of weekly options, we've seen expected move absolutely rule the market. And actually, it's really the stock market that's the option market that's ruling the stock market, right? That's really driving the stock market. And when I, for instance, look at the option chain, I'm looking at a straddle, and I see, okay, it's priced at about, I don't know, let's say 50 handles, right? Let's say it's 50 handles. And again, I'm drawing with a mouse here, so give me a break, guys, okay? If you can read this. This is not so, this is supposed to be 50, I promise. All right, so anyway, it's 50 handles, right? It's 50 handles up, 50 handles down, just for, shits and giggles here. That's the range. That's basically what options are priced in. What does that mean? Well, that's what I mean. People are market makers, and guys like me who are selling options are considering that, okay, in terms of the way things are priced, I expect the market to move within the next week, close actually, not move, close within the one standard deviation, and that basically is 50 handles up and 50 handles down. right? If it's 30 handles, then, well, that's one standard deviation for that particular week. And it's really mostly about the week these days, right? We're moving towards actually 0-day expirations now. A lot of traders are moving into that now because things have become so volatile, but this game is still going on and it's still driving the way options are priced very heavily. So that is basically what you see right here. This is actually the automated one. I usually actually look at the chain. So looking at the actual option chain, and because each chain, and we can take a look at that in a second, has actually its own volatility, and it's usually pretty close to the automated. This is actually taken off the if you look at this range here, it's taken off the annual, right? Of the annual, and then it's just basically takes the square root of 52, right? And then it just basically arrives at that number here, what that translates into. It's usually just a few handles off, to be honest, and it's actually held up pretty nicely. And here we're looking at basically the expected move that was anticipated for this week here let's zoom in a little bit for Credit Suisse. And first up, it opened right at the bottom on Monday, and then kind of moved around a little bit, and then now just fell out of the bed, right? I mean, we're talking about like $1.80 stock. Well, no, actually it's $2.16 stock now, but it dropped as much as $1.78 or something like that. So, I mean, that's quite a fall from grace. And yeah, a lot of times when you see a trade like right there, it's not a bad time to maybe grab a butterfly, maybe around here or something like that, a fairly wide one, because you're probably going to get it for cheap. But you're running a lot of risk, and you have to always be very careful with these kind of lottery trades. I'd like to take them when I see them, but it's something that it is lottery. It's a lottery trade, right? Obviously you can't really make or break your trading career by just lottery trades. And but when these high volatility events happen, this is a particular strategy that I like to employ. Also, sometimes I like to look at the VXX and look at volatility itself. And for instance, let me take a look at this here. See if we've seen the VXX, for instance, right? And that's basically my path, right? It's just an ETN. And, we're seeing these huge spikes right here. So a lot of times when I see something like this, it's actually not a bad idea to go and potentially sell a spread down here. It has worked very well in the past, but these days, with what's going on, and we're looking at DB here, for instance, the banking sector is really being pummeled. And I mean, we have to be careful, right? We have to be careful because we could be looking at a 2 sigma, 3 sigma, 4 sigma event very quickly here. So there are a few things going on though that you should pay attention to. And the banking sector is one thing. What's really driving it, of course, is volatility and an anticipation of a wipeout. And let me go back to the other chart here, actually. Over here, there's something I want to show you in product depth. And I'm going to go to actually the volatility futures. So this is actually really, really crucial because just a week or two ago, I looked at this one. And, for the longest time now, we've had this one in... Oh, sorry. I don't know why it always does that. It was me bonkers. So let me click in here. Nope, that's not it. That's my tool. Okay, no. Okay, let me draw. All right, here we go. I hope you see. Nope, I don't know why it's jumping around, but I'm just going to draw this now. So for the last few weeks, right, and actually for the last few months, we've seen something like maybe like this, right? And these are the contracts, right? So we're looking here based on April contracts, the VX futures, volatility futures that actually expire every month, right? It's a 1 month expiration cycle. Unlike some other futures are weird like that. And right, this is March, this is May, this is June, July, August, and what you're seeing here, right? All of a sudden, what this means, if you all of a sudden see backwardation in the VX futures, that screams at you that the market is anticipating huge short-term volatility. Because what you normally see and what we've seen over the last few years, actually, even through pretty volatile tape or something like this, right? We've seen this basically in contango, and that that's quite normal. You might see a drop in between. You might see something like this, right, where you have like this, or maybe still dip in between. There's always some peculiarities, but in general, when you see this, it's all hands on deck because things are about to get really, really weird, right? And yeah, that's where we're heading right now. All right, so let's also take a look at the bonds, because one thing that really surprised me, right? I have this index. Actually, I have to show it to you on this chart. So let's go here to charts. And I've made this synthetic index, which is actually, just look at price, just price, right? Maybe let's, yeah, just price. And let's give us a little bit more data here. 2 years. All right, there you go. You have a little bit of context. And surprisingly, what you see here is actually a synthetic index I created just out of like the big tech. That's my monsters of tech index. So it's Amazon, Google, Apple, Microsoft, Meta, all that good stuff. And you see these numbers, these multipliers up here. I've tried to kind of normalize them against each other. I probably should update this, but this is usually pretty reliable, right? And you can see it's probably going to be similar on the NQ. Just go to NASDAQ, right? You see big tech in particular is really, really ramping. Why is this happening? Why is this happening in this market? Well, you know, why do you think it's happening? Well, look at the notes, you know, exploding higher. Look at the bonds. Bonds are exploding higher. They're usually correlated. I don't know what that line means, so it's deleted. Let's look at TNX. That's of course, you know, 10-year. Come on, you can do it. 10-year yields are dropping, so that's usually what you want to look at, right? If the yields are dropping, and we're actually hitting support here, as you can tell. I drew this a long time ago, so I didn't just draw that. Very interesting. Actually, let's zoom out a little bit, see if it actually... No, it's been a long time. You know, okay, about drawing lines, I just want to make clear to you guys, again, like with indicators, right? A line is nothing but a line. It's a guide. Yes, there may be a price inflection point here, but again, we're not talking about price. You know? This is TNX, it's just yields. So, but it just shows you where we are, right? Over the last, you know, few years, this was apparently considered an inflection point here. That's where things bounced. And maybe we do see a bounce. Maybe we see, you know, all of a sudden the Fed is going to make an announcement. By the way, speaking of announcements, I just popped in my head. I did a little bit of research before I started recording here and put all this stuff on my screen here. And I want to show you guys. And what's really interesting, actually, let me reload this. Oh yeah, 46 minutes. So I'm recording this right now at 1:30 my time. That you guys are 5 hours behind. Well, the market is opening basically in an hour from now. So it's going to be, okay, yeah, like 15 minutes before the open, I think. This is going to be released right, before the US Open. The ECB rate announcement, and they're actually thinking of raising. The expectation is raising it by half a percentage point, which is quite massive actually. You know, Europe has been zero for a long time, ZERP, and they have been struggling behind the US in terms of hiking cycles, and now they're catching up quickly because honestly they don't have an option. That's the only thing they can do. And that's going to put a lot of pressure on the on the EU economy, actually, and the European economy. I'm over here in Spain right now, and yeah, I mean, you know, things are not rosy. Things are blowing up left and right as well. Anyway, going back here. So let's also take a look at the VIX real quick. All right. So obviously, when I did the introduction, right, I talked a little bit about how volatility, implied volatility is being distributed, and you can see that at work here. Although you're getting actually a distorted picture, right? I mean, if you're looking here, and we're gonna, no, actually I want to go out, not in. Let's go, more data, por favor. How do you like my Spanish? All right, 10 years, something's got to stick, right? So it's been settling a little bit here for the, you know, God, what is this here? It's 2021, and then we started to build this kind of megaphone pattern, right? All right, yeah, I know. I mean, I'm not a big pattern fan anymore. You know, back in the days maybe, but let's delete this. And you can see what we've seen recently, right? I mean, we had a lot of trouble on the horizon, but it was really strange because the VIX was kind of flattening down here, and it was flattening on like 18 mark, which was really surprising. Hadn't been around there for a very, very long time. See this here? Maybe here for a short period of time, and then it, you know, start after, you know, post-COVID, right? Post-COVID. Well, post-COVID sell-off and everything, it kind of started coming down, settled a bit, and slowly creeping up again. And I was looking at this and like, this is not for real. I mean, you know, the VIX is not really that applicable anymore these days anyway. I'll be very careful. But I usually actually look at is the VVIX, volatility, and volatility, meaning how volatile is the VIX? How volatile is the VIX? How fast is it moving? You can see that when you look at back here, right? The VIX, look at this, right? And see how its own volatility drops, right? So what does that mean? What does that mean when the volatility of the VIX drops? Well, it means that the expectation of volatility is becoming less volatile. So, one day you think, okay, it's, oh my God, the world is going to end. Next day is, we're good, we're safe, right? The ECB is coming in, or the Fed is coming. And the next day it's like, oh my God, my bank is blowing up. And the next day it's like, okay. So these are the days where, you see these huge spikes and it's going to come down, right? There's some stick safe, or I don't know, maybe the Fed comes out and, does a little bit of jawboning, and here we go, right? So nothing has really been happening. It's just been really, really quiet. And when you look at the VVIX, right, you can see that, right? You can see how it's really come down. And it's come down quite a bit, because if we're in weekly now, let's go 15 years, let's go big, right? Okay, so now we're getting some context, right? So we're going all the way back to like 2015. See, so that used to be the baseline, and this baseline we've been touching lately. See that? See that? Are we still in 2013? No, we're not. We're not. These days are over, and I mean, we've had a good run, okay, but this has been. You see all the lines here. I kind of want to keep them on. This has to do with some different indicator, but if you look at this, let me zoom in here now, right? Over the last, especially since COVID, right? COVID starts here, right? Explodes higher. And this has been our baseline for the longest time, until like April of last year, right? And then it started coming down and coming down, the expectations. So I don't know. I mean, it's just really the strangest thing to me. But meanwhile, we kept seeing, option price is quite high, a lot of skew. What does skew mean? Well, if we're going into the trade grid, right, and we're looking at, let's say, I don't know, like the spiders, for example, right? And by the way, it's triple witching week, so it's we're gonna see a lot of volatility this week. And actually, that's the last thing I wanted to show you guys. So this is probably a really, really good segue, right, going from here to now we're in the spiders. Sorry, going to this here, right? So that when you're looking here, by the way, you see on the right here, you see the implied volatility for each week, right? And this is, for instance, the expiration for today. We have triple witching. So we had actually on the SPX an expiration yesterday. See that? Weekly. And then we have one today, and we have one tomorrow as well. And what's really interesting here, actually, is quite a lot of big positions are being moved here. If you're actually looking at the SPX, and the SPX is huge. I mean, it's actually, the SPX right now, if you're looking at the trading volume, it's like 50-60% of the market. Sorry, it takes a little bit here for the data to load. Maybe I should pause, and so you guys don't have to wait. Here it is. Okay, so you can see here, right? And you see this right now here, 48%, right? Up front. That's today. 33%, quite a drop. I don't know. That's an AM. Oh yeah, that's the AM expiration. A lot of people get caught sideways by that one. Yeah, there's an AM expiration actually on that's happening actually today. Yeah, there's always one and in triple and quadruple witching weeks. But what I want to show you is like these are big positions, because the SPX is huge, right? In terms of volume, and in terms of notation, right? Monetary notation, it's huge. Notional value. Sorry, wrong acronym. Notional value is huge, right? And so we're looking at huge positions being moved here. And what does that mean? Well, we're going to look at a lot of volatility, right? And that brings me back to, when we're talking about when we're looking at contango, right, versus backwardation now, right? We're looking at a lot of backwardation in the, where is it, market watch? No, charts and product depth. Yeah, we're looking at, okay, sorry, DBX. Pop this up real quick. I have everything linked. That's my bad. So when we're looking at of a sudden backwardation here in the VX, we're looking at a lot of volatility ahead. What does that mean for us? Well, we should be very, very careful, right? Let's go back to the spiders here, for example. Okay, and because there's big positions out there, and a lot of them underwater. So we're going to look at a lot of big moves over the next day. So today, tomorrow, big moves. I think I only have one open position where I'm actually selling credit. I'm probably going to close this one today, because quite honestly, I have very little appetite to take like a 5-10 hour loss or even more. So I'm just gonna have to err on the more conservative side and close this sucker out, because this might get ugly and we might see huge moves in each direction, and it's gonna pop volatility up, and that's not good for anyone who holds credit, selling credit. So to kind of go back to the market itself, let's take a look just one more time at the spiders. Let's look at the SPX. So at the end, let's go purist and just look at the chart here, and you can tell, right? We've been moving in quite a volatile range for a long time now, right? Because you could kind of stick a fork in this right here, right? So to say. And where's the tool here? Let me just draw a line here, real quick. Here. All right. So let's just draw a line here and kind of like, okay, the kind of since April of last year, right? For like almost a year now. See this? Right? For almost a year, we've basically gone nowhere. Nowhere. We've just been kind of swinging around this center here. And here we are. And this thing has to play out. And I don't know, gravity doesn't seem to be, it seems to be increasing. It doesn't seem to be on our side at this point. And I have a feeling if we're lucky, we're probably going to see a pop higher here. But I think in general, the market expects a big move, and it's probably going to be to the downside. I mean, when you look, again, coming back to what we saw on the VX futures, right? We see quite distinct backwardation happening. And yeah, I mean, everything, if tech is getting pulled back, right? I mean, I think the only reason tech is really been popping so quick is because of the yields. And if tech gets dragged down, it's over, because if you're looking at the XLE and you can see this huge move right now, it's like a 2 standard deviation move, right? I just see some news here. Live ECB, second just popped up. They expect to raise its key rates by 50 basis points, but the bank's approach to market turmoil could drive the euro's action. Okay, never mind. Moving on. So here we are. A 2 sigma move here, and what this tells me, we are basically already in a recession, and it's just going to get worse from here. We've been teetering the edge of a recession probably for a long time. This is being propped up. You can see these moves that they have happened before. Here we see one, where we kind of dropped into the abyss and then popped back a little bit. But yeah, XLE looking like this. We're seeing this. It's popping higher here on the expected move front after quieting down for the last few months actually. Let's zoom out a little bit, get a little bit more context. Yeah, it's been quiet, in comparison. It's kind of strange, right? It's been very quiet and now boom, right? So I pay attention to something like this, and even if this signal doesn't mean much, see that? Even if you can't really interpret what the hell does this mean? Again, it's in this case it's the IVZ score, it's the Z score of implied volatility, the IVZ score, and I made this up. So anyway, so when these things happen, usually volatility events are not too far away, right? For instance, here's one, right? See right there. So something like this might happen. Pay attention, okay? I would suggest you keep your hands and feet inside the vehicle at all times. During this, what remains of this week and also next week, things are getting turbulent. Don't take big risks. Oh, one more thing before I let you go. And it's been already a long video, so I apologize. But okay, one more thing. Let's pop up the VIX one more time, okay? And just kind of take everything away, just the daily price, okay? No indicators, okay? So VIX right now, 27, okay? And this is not an environment where you want to buy puts, because if there's already rumblings that the Fed is probably going to start easing again as opposed to hiking. Is it going to happen? Hell, how the hell do I know? I don't know. I don't have a crystal ball. It's still in the shop. And it's, there's no telling what's going to happen, but with here, 27 VIX, you do not want to buy some puts and then all of a sudden there's some kind of announcement and boom, we see it bound at 21 or 20 or something again, which could easily happen. Has it happened before? Oh yeah, it has happened before. It has happened many times. It happens here, for example. That's quite a big move, trust me, right? It doesn't look like much on the chart. 33 down to 28, well, that cuts your premiums in half and then some, okay? So I'll leave you with this. Okay, be careful this week. Things are getting, coming apart at the seams, and you don't want to take big bets. So I'm gonna be very, very selective when it comes to my trading, and well, so should you. And in this kind of environment, and these are my parting words, and I'll finally let you go. In this kind of environment, asset protection is always the key. That's really your prime concern. Okay, nothing else matters. Not losing your ass, and live to trade another day. All right, have a nice weekend. Cheers.